What's going on, everyone? Happy 4th of July weekend. I hope everybody got to get outside, enjoy some sun, hang out with friends, get some food in you. It seemed like it was pretty nice across most of the country this weekend. So, not the 4th of July that anybody was hoping for as we entered the year, but hey, sometimes you just got to make do. So, back to our weekly market updates. It's been 2 weeks since I've given you guys one, and that was not intentional. I've just had friends and family in from out of town for pretty much 2 weeks straight now. So, this was kind of the first weekend that I could sit down and shoot this for you guys. But it was a good week to take off last week, honestly. Not a ton has happened in terms of price movement, and we'll see that on the charts here in a couple minutes. So didn't really miss out on much by not having one last week. So we'll go into the charts and see what things look like and what we've got to look for going forward. And then I'm going to point out one chart pattern that's really it's rare. We don't see it very often, especially in indexes, more in commodities, but that has happened within the last month to keep an eye on, because if it holds, it's usually very strong. So we'll look at that, and then we'll go to the fundamentals. I'm not going to talk about COVID today, honestly, like maybe for 30 seconds, but there's no reason to. You guys see the news, you know what's going on with COVID. It's not like it's this enigma that nobody knows what's happening. So just beating a dead horse if we go talk about that for a ton. So that being said, let's get into the charts and see what's happening here. So here's our S&P 500 futures that we look at all the time. I chose to do the 6 hour here instead of the 2 hour, just because two things. Number one, as I mentioned, price hasn't changed a ton since the last weekly update 2 weeks ago. And number two, it makes it easier to see this since it's been 2 weeks rather than zooming in on the 2 hour. So here's where I updated you guys last 2 weeks ago. And we had gotten up and I mentioned, hey, watch out for this 31.75 level after we had this sell-off. And in the last weekly video a couple weeks ago, we hadn't quite gotten there. And I told you guys, I don't know how I feel about this one. We aren't really close enough for me to feel good about that being called a legit test of that resistance level. But it's close enough that if it goes down, we were in the range. But we need to kind of wait and see what happens. And that's really what's played out here. You can see we stalled for about a week, and then we sold off, then we've come back up, and really the price is no different. I mean, if you went to bed 2 weeks ago after my last update video and woke back up right now, we're in the exact same situation we were then. So nothing dramatically different. And this matches the timeline that I've been believing and telling you guys since March, April range, in terms of, okay, we're going to have this optimism run up, and then the next real big area to watch for is when we hit earnings season. But that would be when I would expect, if we were going to have another sell-off, that it would potentially come. And that's lining up now, right? We've been consolidating for a couple of weeks, and earnings season is about 2 weeks away. I mentioned to you at the beginning of June, I said, hey, I think June could be the last kind of run up and run out of steam for our bull trend, and we'll kind of stall out a little bit. And then as we go into July and hit earnings, that's when things can start getting a little bit more volatile and dicey. And that is kind of playing out as we speak right now. So especially as, of course, cases soar across the country as of right now, not really affecting businesses a whole ton, but if things get out of hand, that plus earnings can make things pretty volatile. So just something to keep an eye on, that, this week, I would expect this week to maybe not be super strong in terms of dramatic price movement, but then that could be kind of the last calm week of volatility, and then we could really start to see a spike the third, fourth week of this month going into August. Things could just get a little bit more out of control. So keep an eye on the price. You notice that we've held this 31.50 level 3 times now. So if we get a break up through here, we would expect to see it be pretty strong. And if that would be the case, then we would expect to see a new high come in at the same time as it broke through, or at least a double top. But we should definitely see a new high if it breaks up through here hard. And then if we want to go to the downside, we need to see new lows come in. So that's the charts. The one chart I wanted to show you guys, I need to switch over to the SPY rather than the futures. And in case you're not aware of the difference between the two, is the SPY this is the ETF of the index. So this doesn't trade, this trades like normal stock hours versus the S&P 500 futures. That you can see here, these hours are totally different. There's only 1 hour a day that the futures don't trade, whereas the indexes trade from 4 a.m. or stocks and these indexes trade from 4 a.m. until 8 p.m. every day. So you'll see a little bit different of a price movement here. Okay, so if we look at the SPY now, the ETF for the index, I want you guys to notice these few bars and this thing called a gap. So you can reach out to me individually, or you can Google this stuff on your own to try to get a little bit more information on it. But gaps are really important to us as technical traders for stocks and commodities. And the most common ones are things like this, where you see this breakaway gap. And basically, what is that saying? That the price overnight from where we closed the day before to where it opened the next day is dramatically different. So there's been a strong change in view of the market, and this would be considered a breakaway gap. And that's usually the initial gap of a trend. Then you get something like this, where you get a continuation gap, and then you get one to the bottom that we usually call an exhaustion gap, where it's running out of steam. And we actually see it. Let me hide the volume so it makes it easier. Right, you can see it here to the downside too. Right, here's a breakaway gap to the upside. Then here you get a continuation gap, and now we're up here, and this would be considered an exhaustion gap. But what's important about this is called an island reversal gap, and you can Google that and read all the technical reasons for it. But it's anytime you get this strong break and gap up, then you consolidate for a few days, and then that same area that gapped up through gets broken back down on another gap. It's really, really strong indicator, especially for commodities. We don't see this very often, especially in these ETFs for the indexes. I think it happened once before back in 2016. Yeah, there it is. So we were selling off pretty hard, and again, you can see breakaway gap, then we had a bit of a continuation gap, and then we got to the bottom here, and you can see a gap down, consolidation for a few days, and then a gap right back up through where that level was. That would be the island reversal gap there, and then you can see that the market ran pretty hard after that point in time. So just something to keep an eye on. We don't see this very often, so we would want to definitely, based on this level should hold as a resistance level really, really well. So if we bust on up through there and close this gap, meaning that we get a candle that fills it and it's no longer a gap anymore, then it would be invalid. But if it's not, this is really important to keep an eye on, and would kind of match our timeline here that things are going to stall and then go down as people start to realize the numbers. So again, you can Google that if you want. That's just a real brief overview of kind of how these gaps work, but it's really important. We see that like once every 5 years. So definitely want to keep an eye on. So there's our price movement. You guys know the levels to watch for: new highs above 3150 or new lows coming in. Until one of those things happens, we are sideways. So let's go into a fundamental view here for a second and kind of talk about a few things. So number one, the COVID situation. Obviously, cases are spiking across the country. The only thing I want to say is somebody pointed this out to me the other day. I can't take credit for it. But even though our cases are soaring here, obviously across the country, take a look at the death rate and the chart of the deaths in the country. So I've got it pulled up here, right? So here's our new cases. Obviously, everybody knows we're definitely soaring again, and with 4th of July just happening, probably not going to be pretty for the next few weeks. But if we look down at the death curve, this has stayed relatively calm. And so now that this has really been, about 2-ish weeks that we've really started popping again in terms of cases, I think this next week will be kind of pivotal to see whether or not this turns and goes back up, because obviously the deaths are delayed with the caseload. But the fact that we haven't started seeing this spike yet is promising news. And really, at the end of the day, just my view, this is what's the most important, right? Is, okay, yeah, it sucks if we're getting a ton of new cases, and we don't want that, and we need the hospitals and everything. But if we're just getting a ton of new cases, but we're not seeing a rise in deaths, that's a really good thing. And then it is just like the flu, like people are talking about, and it sucks that people are getting it. So that's the only thing I want to say on that. But do keep an eye on that. Obviously, you guys know to watch the headlines of COVID as things start to get a little more dicey here, and governors start to scratch their heads and go, shit, should we be doing something different and closing down and blah, 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 blah. That's all I'm going to say in terms of COVID. So let's move over to the other fundamental piece of things. One other thing. So Beijing, we talked about a few weeks ago in terms of their breakout in the market. So how did they contain it? That story completely disappeared because they only got 29, I think, cases total that came from that. Well, that city has 22 million people in it. within a week of them finding the issue in that market, they tested over 7 million people in there and contact traced all of them and quarantined everybody that had any form of contact with anybody that showed signs for 28 days. And that's how you contain this thing, whereas we're just going out and doing it. So that was definitely something to be on alert for, but I'm glad that it didn't turn into a whole spiraled situation, and props to China for doing their job to make sure that they keep their whole country good and not worry about what it costs people in terms of having to stay at home for a couple weeks. So, all right, non-COVID talk. I'm gonna switch back over to the charts here. I think it's just better than leaving up the update screen. But in terms of what drives the market higher, right? So if we go back to square one, and what I said at the beginning of this video and what I've probably talked to you guys about each individually is, what is the stock market at the end of the day? It's eBay, right? And if you've got something that you're trying to buy or sell, the more buyers you have, the stronger the price is going to be. The more sellers you have, the lower the price is going to be. It's just Econ 101, supply and demand. So obviously there was needed to be some optimism here and people going, hey, okay, it's time to buy back in and these companies are going to get through this and all that sort of stuff. But after we really pulled back, 50-60% of the losses that we made, and we just continued to rally up, and the NASDAQ made new highs and all this stuff's going on, you look across the board to CNBC and all these other, institutional investors are sitting going, the market is so extremely overvalued. This is insane. Like, why? How can the prices be going up? And we were proven wrong and all this sort of stuff. And so it made me take a step back and go, okay, well, what would cause that? And I think we're seeing potentially some investment stuff changing before our eyes. So you can Google, if you just type in hedge funds to Google, you're going to see stories like this. Big hedge fund manager decided to quit. And we've seen this in the last few weeks. Multiple major hedge funds have decided to give their investors back their money and become family shops. So what does that mean? It means we're living in a time right now where in the past, people have just, if any money they have sitting around that they want to invest, they've got to basically give to somebody to invest for them. And then hedge funds have taken a 2 and 20 fee, which basically means they take 2% of the investment and then 20% of profits, usually profits that are above a certain percentage, right? So if they make 15%, they might give you the first 5 and then take 20% of the profits above that 5%, if that makes sense. And as ETFs, more and more ETFs are rolled out, you get apps like Robinhood making it way easier for people to invest. There's not been as much of a need for hedge funds and 2 and 20 fees, because why would, and I ask my mom this question all the time, like, why would you pay somebody to manage your portfolio if you could just put your money into an S&P 500 index and let it run? You are diverse there. You're diverse by 500 companies, and you can do it for every sector, and you can do it for all these different things. What's the point of paying somebody for that? And it's just become harder and harder and harder for hedge funds to make the returns that they used to. And so I believe it's something like $890 billion has been taken out by investors, withdrawn from hedge funds this year, which is like 3.5 times what it was in all of 2018. So in terms of buyers and sellers, what would that mean then? Well, that would basically mean if you can just go on Robinhood and now you don't even have to buy a whole share of Apple, you can buy $10 worth of Apple stock, right? All of these new enhancements and platforms and everything are just giving easier access to everybody that wants to trade or invest to do it on their own, which means that you have way more speculative market people in the market right now than institutional guys. So in the past, where we might have gotten here and the institutional guys all would have looked and analyzed and broken it down and gone, okay, this thing is severely overvalued, and we wouldn't have seen this continued run up. Well, now you're still just getting people that are just turning on the news, seeing headlines and going, you know what? I want to buy Apple. Absolutely, I want to buy Amazon. I want to buy all these companies. And they're opening Robinhood or whatever they use, and they're just doing it right there, and boom, it's done. And they're speculating. And that's a good thing to an extent, for people being able to easily access the markets. But at the same time, if something happens that causes this to tank, it's also going to be, you're going to see some really nasty, ugly stories of people losing tons of money, way more than they would if they had quote unquote professionals managing it for them. Robinhood already got in a little bit of trouble. I think it was 2 weeks ago because some guy got over leveraged and lost so much money that he committed suicide and left a suicide note that basically outlined, hey, I made all these trades and was way over leveraged and blah, 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 blah. So Robinhood got some fire for, hey, why did you let that guy become that over levered? But that's what people want right now. Everybody wants to be able to do this stuff on their own and do it as big as they can, as hard as they can. And I think that's why you're seeing this market continue to run as hard as it is because this is no longer, institutional guys don't have as much percentage in the marketplace, even though they still own it. They don't have as much as they normally would. And so you got a lot more people that can just throw money in there and just go, sure, I'll throw $100 at Apple or Microsoft or whatever, and you get that times a million people. You got a lot of money flowing into the market that probably wouldn't be doing so if all these enhancements weren't out there. So the reason I said at the beginning of this that could be really good or really bad is that if that is the case, to the downside, what could happen is if people get worried, now not only would you have those institutional investors selling, but you would also see something like this, because then everybody that bought using their apps or whatever accounts are going to go, oh shit, I should probably get out of these now, and because things are going to get dicey, and you're going to get a combo of hardcore selling by the big dogs and by the little dogs. And if you see that, that's something that could result in really, really, really strong sell-offs. But that's just a thought. I'm not entirely sure if that's the case, but I definitely think it's something interesting to note, because there's definitely, you look at the amount of money that institutions have bought in since the beginning of June compared to retail investors. Retail investors, the trade volume by them is almost 200% what it was back in October of last year, right? So that's just saying, hey, all these people, mom and pops and Joes and all this, throwing their money in, and they're doing the trades on their own. So we just got to keep an eye on the sentiment of the market. That's why I always tell you guys, look at what's going on outside and see if you can take something away from how people are feeling, what they're thinking, because now more than ever, I think we're really starting to see that this is going to come and turn into a stock market of the masses, and what are people thinking and feeling at a given time. And if everybody's kind of feeling the same way, the market's going to react much stronger than calmer headed people like institutional investors who manage money for a living. It's just going to be a little bit more volatile. So didn't really have a great kind of way to throw that all at you guys, but it's something to keep in the back of your minds as we go forward. So like I said, we'll see how this week goes. As of this moment, don't expect anything super drastic. I don't, at least. But if we see something strong and we get either of these levels broken, see some pretty strong movement. But then as we get into the next few weeks of this month, we'll really start to break down and look at everything and see, okay, what do earnings look like, how people reacted, and just make sure you're aware of all that stuff going on, because volatility could increase. So have a great week. Update you guys if anything big comes. Otherwise, talk to you next week.